Break-even analysis. I first started writing this course as a course on break-even analysis. Break-even analysis, cost volume profit analysis, sensitivity analysis, and marginal profitability have been very useful for me throughout my career. I had already covered these concepts in my marginal profitability course. I wanted to make courses that focus more on common decisions faced by companies and how to apply these concepts. Opening and closing locations are two areas where I've used these concepts. If you asked 100 people for a revenue projection for a new location, you would probably get 100 different answers. When a group has many options to decide between, it's very hard for them to make a decision. Getting to a decision with this many options takes lots of time. I've also had sales or revenue projection conversations that start similar to the expenses. Me. What do you think revenues will be in the first year for the new location? Person I'm meeting with. I don't know. Yes, they truly don't know. This is a fact, but it's not very helpful for building a projection. How do we move the conversation forward? One way is to keep working with this person to arrive at a number or a range of numbers they think is reasonable. Another way is to see if they think the new location sales can exceed the break even amount. Break even is usually defined as where revenue equals cost, so profit is zero. Most businesses aren't aiming to just break even with no profit. They expect to make some sort of profit or hit some key ratio. They may want to at least cover their cost of capital. This means the relevant target in a break even analysis isn't just breaking even with no profit, but some higher profit amount. Opening a new location is usually a yes no decision. You will open the new location or you won't. Yes, there can be many decisions about the size of the location, the number of new locations in a market, etc. However, the purpose of this exercise is to reduce the decision to a binary decision of open or don't open the location. This is matched with the binary decision over whether we think we can sell enough to hit our break-even amount, however you define break-even. If we can hit the break-even amount, we should open the store. If we can't, we shouldn't. Let me pause and reassure you that this is not the complete basis for making the decision. This is just one way to analyze the decision. You could think of the decision as answering three questions with increasing amounts of complexity. Can we sell enough to break even? Answered with the break-even analysis. What is our likely profit? Answered with the forecast. Are we comfortable with the range of potential outcomes? Answered with sensitivity and scenario analysis. By the way, for CPA types, there is a technical difference between a forecast and a projection. According to the AICPA, the American Institute of Certified Public Accountants, a forecast is based on the responsible party's assumptions reflecting the conditions it expects to exist and the course of actions it expects to take. A projection is sometimes prepared to present one or more hypothetical courses of action for evaluation. In other words, we are making projections when we're looking at potential scenarios for a new location. Once we decide to open the location based on a most likely projection, we have a forecast. Break-even analysis is a version of sensitivity testing. Sensitivity testing analyzes the impact of an outcome from changing one or more inputs. You should do sensitivity testing for the potentially important assumptions or variables in your decision. In a sales break-even analysis for a new location, we're testing the most uncertain variable in the revenue projection. That's units sold. Let me break down the basic variables of a revenue projection to explain why we're isolating units sold as the single variable to test in the break-even analysis. At first, I'm going to walk through this for one product. Don't worry, I'll explain how to analyze multiple products later. Your gross revenue is your units sold times their price. My guess is that you are more certain about the price you will set your products at than the number of units you will sell at the new location. The uncertainty about the number of units is why we're analyzing that as the input variable in the break-even analysis. Break-even is a profit analysis, so we need to look at the cost variables. There are two main categories for these costs: variable costs, costs that vary with the number of units sold, and fixed costs, costs that don't vary with the number of units sold. In my marginal profitability course, I talk about a third category of costs called fixed step costs. Variable costs go up with each unit produced. Other costs, like machine costs, don't go up with each unit, but once you reach your machine's capacity, you may buy a new machine. In other words, your costs don't increase until you cross a threshold and then need to make a significant increase in costs. That's a fixed step cost. In the context of a new location, you may need to hire another employee when sales hit a certain level. Commissions or bonuses may take a big step up when sales at the new location reach a certain level. These are step fixed costs. For simplicity, I won't model these in the examples that follow, but you will need to add them to your formulas if you have them. Variable costs are not the same as direct costs or cost of goods sold. Inventory costs of a retailer or materials costs in a manufacturing plant are variable costs and direct costs. If you have salaried employees, their time may be directly tied to the producing a good or providing a service, but the amount you pay them doesn't vary with the number of units produced or hours of service billed. This is also true of people paid hourly wages that work the same number of hours regardless of the number of units sold. For example, in a retail store, you may pay a certain number of employees the same amount whether you make zero sales up to a certain amount. After sales reach that amount, you will have hourly staff work more hours, a variable cost, or add salaried staff, a step fixed cost. You're ready to calculate the profitability at your new location across multiple sales amounts once you've categorized your costs as variable or fixed. The formula is number of units sold times price minus number of units sold times cost minus fixed costs equals profit, which summarized is gross revenue minus total variable costs minus total fixed costs equals profit. We can enter different sales units amounts to derive the related profit. This is called cost volume profit analysis. This can be graphed into a CVP graph. This graph can show us where we break even. Let's assume the price of your product is $500 and the variable costs are $100 per unit. You have fixed costs of $10,000. You can assume different units sold to determine varying profit amounts. The formula is profit equals number of units sold times 500 minus number of units sold times 100 minus $10,000. Here's a graph of the profit from selling 0 to 150 units. You can see from the table of values above and the graph that you break even somewhere between 20 and 30 units sold. What if you want to know the exact number of units you need to sell to break even? The formula for this is number of units sold times 500 minus number of units sold times 100 minus $10,000 equals $0 profit. Using a little algebra, this formula can be restated as $0 profit plus $10,000 fixed costs divided by $500 price minus $100 variable cost equals units sold. The break-even number of units is 25. You may be tempted to simplify the restated formula to fixed costs divided by your gross profit. That's not correct unless your cost of goods sold or direct costs are also all of your variable costs and don't contain any fixed costs. This goes back to what I said earlier about categorizing costs. If you're not a fan of using algebra to find your break-even point, you can use GoalSeek in Excel to find it. I'll show you how in a later lesson. I've also given you an Excel template like the earlier graph where you can enter some revenue and cost accounts to build a CVP graph. It also calculates the break-even volume for you. This course comes with a few lessons about how to analyze data in Excel. I wanted to make a quick note about the balance I try to strike in these videos. They are short overviews of how to perform the analysis. They give you a glimpse of how you may want to analyze the data. They aren't long, detailed, step-by-step videos on Excel functionality. If you want that, do an internet search on the Excel functionality and you'll find many good websites and videos. Others of you are well versed in some of all the Excel tools I'll show, and I don't want to waste a bunch of your time. It's time to pull away from the detailed numbers and look at what we can learn from the CVP graph. A CVP graph is a simple way to see your potential profit across a wide range of sales amounts. This is a simple form of sensitivity analysis. Each person in the room deciding whether to open the new location will likely have a number in their head of the number of units they think the new location can sell. They can quickly see how much profit that produces and what the profit becomes if sales are a little above or below that number of units. The point where the line hits $0 profit is your break-even volume. The big question for decision makers is, how confident are we that we can sell at least this many units? To simplify that to a yes-no question, the question is, can we sell at least the break-even volume of 25 units? This takes the analysis of all the possible outcomes to whether to open the new location to a simple yes-no question. Once again, you shouldn't make your decision purely on break-even, but it's a way to help the group decide when they are overwhelmed by too many options and outcomes. As I mentioned earlier, break-even may not be the critical yes-no point for you. For example, you may want to make at least $10,000 to justify the commitment of time and capital for the new location. You then ask the same question, can we sell at least the 50 units needed to make a $10,000 profit? I've been in meetings where a huge amount of time was spent debating the likely amount of units the new location will sell. Especially in the early stages of analysis, that time could be better spent on other questions. If you are confident you can hit the break even volume or some other minimum threshold you set, you should continue pursuing the new location, even if you aren't as confident of the expected likely volume. A group may not agree on an expected likely volume, but may agree on a range of volumes. This range will map to a range of potential profit amounts. The group can then decide if the returns are reasonable. In the early stages of analysis, spend less time on the details of a more likely scenario and focus on this range of outcomes. You will need to lock in the more certain assumptions to allow the less certain and more crucial assumptions to vary. In the analysis we looked at, you want to have reasonable price, fixed cost, and variable cost assumptions determined to allow you to vary the uncertain sales amount. You can set a likely volume amount or small range later in the due diligence process for more detailed analysis or to do sensitivity analysis of other variables.